In October of 1907, a man named Charles Barney sat in his study and wrote a letter to his wife. He was a banker, well-connected, respected, trusted with the fortunes of some of New York's wealthiest families. 3 days earlier, his bank had been solvent. Now it was gone. Depositors had lined up around the block in a panic that spread faster than any explanation could contain. Barney knew what was coming. He had seen the accusations, the whispers, the blame. The next morning, he shot himself. His death did not stop the panic. It accelerated it. And in the investigations that followed, one detail emerged that no one wanted to examine too closely. In the months before the collapse, Barney had believed, along with nearly everyone else in American finance, that the old rules governing banking no longer applied. The trust companies had found a better way. This time was different. Those 4 words appear in every financial collapse in recorded history. Not as a slogan, not as marketing, as a quiet, personal conviction that spreads through a population like a contagion, invisible until it has already infected the entire system. The LIE doesn't announce itself. It hides inside genuine innovation, real transformation, legitimate change. And that's what makes it so dangerous, because it begins with truth. When the South Sea Company launched in 1711, it was built on something real. The British government was drowning in war debt from decades of conflict with France. The company offered a genuine solution, a mechanism to convert that debt into equity, to restructure the obligations of an empire. The early investors were not fools. They were buying into a legitimate entity with a legitimate charter and legitimate government backing. But somewhere between the genuine opportunity and the peak of the mania, the justification shifted. By 1720, the company's stock had risen 800% in a single year, and the people buying at the top were not buying the business. They were buying a belief. The belief that the old metrics, the old valuations, the old warnings no longer mattered. Because this time was different. Isaac Newton lost a fortune in that collapse. A man who could predict the motion of planets with mathematical precision could not predict the motion of crowds. He wrote later that he could calculate the movement of heavenly bodies, but not the madness of people. But it was not madness. It was something more insidious. It was a collective rational response to a system that had changed its rules. And once the rules change, the old warnings stop making sense. The LI does not say the past was wrong. It says the past is irrelevant, and it offers evidence. Real evidence. In the 1920s, that evidence was electrification, mass production, the automobile, radio, and aviation. These were not fantasies. They were genuine transformations of the American economy. When economists and financiers spoke of a new era, they were not hallucinating. Industrial productivity had genuinely accelerated. The application of scientific management to manufacturing had genuinely increased efficiency. The Federal Reserve had genuinely been created to smooth out the banking panics that had plagued the previous century. The evidence was everywhere. And the evidence said that the boom and bust cycle, that brutal rhythm that had governed economic life for generations, had finally been tamed. So when stock prices climbed to levels that would have seemed insane 5 years earlier, the response was not skepticism. It was recalibration. The old price-to-earnings ratios were artifacts of a primitive era. The old margin requirements were obstacles to the efficient allocation of capital. The old conservative banking standards were relics of a time before modern finance understood how to measure and distribute risk. This time was different, and the people saying it were not lying. They believed it. The broker extending credit believed it. The banker approving the loan believed it. The investor buying at the peak believed it, because all of them had seen the evidence. This is the architecture of the LIE. It does not contradict reality. It reinterprets reality. It takes genuine change and extrapolates it into permanent transformation. And because there is genuine change, the extrapolation feels rational. The person who points out that prices have detached from fundamentals is told they do not understand the new fundamentals. The person who warns about leverage is told they do not understand the new instruments that have made leverage safe. The person who suggests caution is told they do not understand that caution, in this environment, is indistinguishable from cowardice. By the summer of 1929, buying stocks on margin had become normalized. Ordinary people who had never invested before were borrowing money to buy shares in companies they could not evaluate, in industries they did not understand. They did not need to understand. The line went up. Month after month, the line went up. And the people who had hesitated, who had waited for prices to become reasonable, who had insisted on the old standards, had watched everyone else get rich while they stood on the sidelines. The psychological pressure was not subtle, it was overwhelming. And it was not irrational to succumb to it, because the penalty for being wrong early was indistinguishable from the penalty for being wrong permanently. When the market collapsed in October of 1929, the shock was not just financial, it was existential, because the promise had been so thoroughly internalized. The institutions that were supposed to be safe had been making the same bets as everyone else. The diversification that was supposed to protect wealth had concentrated exposure instead. The regulations that were supposed to prevent excess had been rewritten or ignored because they no longer fit the new reality. And the new reality turned out to be the old reality in a more expensive suit. What followed was not just a market correction. It was a collapse of trust, because the lie had not just been about stock prices, it had been about the entire framework. The belief that the people in charge understood what they were doing, that the system had evolved beyond the primitive vulnerabilities of the past. That expertise in technology and institutional sophistication had finally solved the problem of financial instability, and when that belief shattered, it did not shatter gently. The reforms that followed were comprehensive. Glass-Steagall separated commercial banking from investment banking. The Securities Act imposed disclosure requirements. The Federal Deposit Insurance Corporation guaranteed deposits. The structure was redesigned to prevent the specific failure modes that had occurred. And for a generation, it worked. Not because the regulations were perfect, but because the memory was fresh. The people running banks in the 1940s and 1950s had lived through the Depression. They had seen the consequences. And that memory acted as a restraint more powerful than any law. But memory fades. By the 1980s, the Depression was history, not experience. The regulations that had been written in its aftermath seemed outdated. The separation of commercial and investment banking looked like an arbitrary restriction in an era of global capital flows. The limitations on leverage looked like obstacles to efficiency in an era of sophisticated risk modeling, and the warnings about speculation looked like the complaints of people who did not understand that the world had changed. Because it had changed. Computers had transformed trading. Derivatives had transformed risk management. Globalization had transformed capital allocation. This time was different. The phrase didn't appear in quite those words. It appeared as the great moderation, as the end of volatility, as the new economy. But the structure was identical. The old rules had been written for an old world. The old dangers had been engineered away. The old warnings were the pre-scientific age superstitions. And the evidence was everywhere. Inflation had been tamed. Recessions had become milder. Financial innovation had distributed risk so widely that no single failure could threaten the system. The models said so. The experts said so. The market said so. When housing prices began their ascent in the early 2000s, the justification was reasonable: population growth, limited housing supply in desirable areas, low interest rates making homeownership more accessible. These were real factors. But as prices climbed, the justification evolved. Housing prices nationwide had never declined, not in the data, not in living memory. So the models used to assess mortgage risk were built on that assumption. And the models said that lending to borrowers who could not document income was not reckless, it was efficient, because the collateral was safe. Housing prices could not fall. They never had. Not all at once. Not everywhere. This time was different. The LI embedded itself in technical language, in the rating agency models that gave subprime mortgage securities the same safety rating as government bonds, in the regulatory frameworks that allowed banks to hold less capital against risks that had been quantified and distributed, in the compensation structures that rewarded short-term performance without accounting for long-term fragility. None of these were conspiracies. They were rational responses to a system that had, genuinely, changed in important ways. But the changes did not eliminate risk. They obscured it. When the collapse came in 2008, it followed the same pattern as every collapse before it. A small crack appeared. An institution that was supposed to be safe failed. Bear Stearns. Then, the questions began. If they failed, who else might fail? And once the questions started, the answers did not matter. Because the system was not built on solvency, it was built on confidence. And confidence, once broken, does not repair itself through explanation. The gap between what people believed was true and what was actually true revealed itself the way it always had, suddenly, completely, and with consequences that spread far beyond the people who had made the initial bets. The pension fund that had bought AAA-rated securities, the money market fund that had bought commercial paper, the insurance company that had sold credit default swaps. None of them thought they were taking existential risks. They thought they were following best practices in a world where risk had been properly understood and properly managed. They thought this time was different. It never. Not in the way that matters. The details change, the instruments evolve, and the vocabulary updates. But the structure remains. A genuine innovation creates a genuine opportunity. Early participants profit from recognizing the change. Their success attracts attention. Capital flows in. The opportunity becomes crowded. Returns compress. But the capital keeps flowing because the story has become more powerful than the mathematics. And the story always says the same thing. The past is irrelevant. The old rules do not apply. The skeptics do not understand. This time is different. The lie works because it is never completely false. Things do change. Technology does transform economies. New tools create new possibilities. The mistake is not recognizing the change. The mistake is believing the change has repealed the laws of gravity. That leverage is safe if it is complex enough. That risk disappears if it is distributed widely enough. That prices can rise forever if the story is compelling enough. And most importantly, that human psychology, in the face of rising asset prices and social proof and institutional validation, will somehow behave differently than it always has. Charles Barney did not die because he was foolish. He died because he was human. He had watched a system that appeared to work. He had seen sophisticated people embrace it. He had heard the assurances from experts, and he had believed, as everyone around him believed, that the rules governing trust companies in 1907 were different from the rules that had governed banks in 1893 or 1873 or 1837. He believed this time was different. And when it turned out not to be, when the same panic that had destroyed banks for centuries destroyed his institution in days, the weight of that belief became unbearable. The lie will return. It is already returning. Somewhere in the financial system right now, there is a genuine innovation creating genuine value. And around that innovation, a story is forming. A story about how the old metrics do not capture the new reality, about how the old risks have been engineered away, about how the old warnings are the complaints of people who do not understand what has changed. And the story will be believed, not by fools, but by intelligent people responding rationally to the information available to them and the incentives they face. And the belief will spread, and the system will expand, and the gap between belief and reality will widen, invisibly, until the moment it becomes visible to everyone at once. The collapse does not happen because the lie is told. It happens because the lie is believed. And it is believed because, for a time, it works. The early believers get rich. The skeptics get left behind. The institutions adapt. And by the time the gap becomes unbridgeable, too many people depend on the lie to allow anyone to question it. This is not a failure of intelligence. It is a feature of systems built on human psychology, operating under incentives that reward optimism and punish caution. In an environment where the penalty for being early and the penalty for being wrong look exactly the same, until after the outcome is known. The one lie that starts every financial collapse is the same lie that started the last one. And it will start the next one, because the lie does not need to convince everyone. It only needs to convince enough people for long enough that the gap can open. And once it opens, the collapse becomes inevitable. Not because of greed or stupidity or fraud, though those are present, but because of something simpler and more intractable. The belief that this time is different,